in favor of corporate mergers. Corporate mergers are powerful strategic tools that enable companies to achieve scale, synergy, and market expansion. When executed properly, mergers can deliver substantial value for shareholders, customers, and employees. One of the primary advantages is economies of scale. Combined firms often reduce redundant operations, streamline costs, and boost efficiency. Additionally, mergers allow for market penetration and entry into new geographic regions, giving businesses a competitive edge. Mergers also often lead to diversification of product portfolios, risk mitigation, and increased R&D capacity. This strategic alignment enables innovation and long-term growth. A great example is the Disney-Pixar merger. Before the merger, Disney's animation department was losing ground. The acquisition of Pixar in 2006 for $7.4 billion not only revitalized Disney's animation, but also led to a series of blockbuster films and increased global brand value. Another notable success is the Exxon-Mobil merger in 1999, which created one of the world's largest oil companies. The deal generated billions in cost savings and allowed the company to remain competitive in a volatile global energy market. Even in tech, the Facebook-Instagram merger allowed Meta to consolidate user engagement and enhance its advertising platform. Instagram remained a separate brand but gained access to Facebook's infrastructure and monetization tools. Critics often highlight cultural clashes and integration risks, but these can be mitigated with strong leadership and clear vision. When businesses focus on strategic fit, corporate governance, and stakeholder communication, mergers are not only feasible, they're transformative. In today's global economy, where innovation cycles are shorter and competition is intense, mergers are often the best route to staying relevant and driving growth.
The risks and failures of corporate mergers. While corporate mergers are often marketed as growth catalysts, they frequently result in operational chaos, cultural conflicts, and significant financial losses. The promise of synergy is too often overstated, while integration complexity is underestimated. One of the most critical issues is the clash of corporate cultures, which can lead to talent drain, internal resistance, and long-term dysfunction. A striking example is the AOL Time Warner merger in 2000. Valued at over $165 billion, it was once seen as the deal of the century. However, the cultures of the two companies were incompatible. AOL's aggressive internet culture clashed with Time Warner's traditional media values. The result? The merger unraveled in just a few years, leading to billions in losses and a tarnished reputation. Another failure was Daimler-Benz's merger with Chrysler in 1998. The aim was to create a global auto giant, but fundamental differences in management style and market strategy led to years of underperformance. Daimler eventually sold Chrysler to massive loss, and the brand never fully recovered. In the tech industry, Microsoft's acquisition of Nokia's mobile unit is another cautionary tale. Despite heavy investment, Microsoft failed to revitalize Nokia's market presence, and the division was ultimately written off. Beyond financial loss, poorly managed mergers can devastate morale, destabilize industries, and destroy innovation pipelines. Moreover, regulatory scrutiny is increasing globally, making large-scale mergers more difficult to execute legally and ethically. In short, while mergers may look attractive on paper, the post-merger integration phase is where most fail. Without meticulous planning, cultural alignment, and realistic expectations, mergers can become liabilities rather than assets, damaging not only companies but entire ecosystems.